we're going to peel back the layers on what really drives a company's performance. It all comes down to a simple story: risk versus reward. And we're going to see how a massive tech giant making the world's most advanced chips and a tiny local bank are basically playing the exact same game, just with completely different stakes. Let's dive in.
So let's start with a bit of a puzzle. How on earth can a company that builds the literal brains of the AI revolution and a small community bank that serves a few towns possibly be telling us the same story? On the surface, it sounds crazy, right? But stick with me because the answer is fascinating.
And here are two main case studies for today. On one side, you've got TSMC, this global behemoth whose technology is inside, well, pretty much every advanced gadget you can think of. And on the other side, Bank 7, a super-focused community bank. The scale couldn't be more different, but you're going to see that the fundamental choices they make are surprisingly similar.
Okay, first up, the giant. You just can't have a conversation about technology, and especially not about the AI boom, without talking about TSMC. And I'm not exaggerating when I say they are one of the most critical companies on the face of the earth right now.
So what do they actually do? Well, TSMC is what's called a semiconductor foundry. Think of it this way. Companies like Apple or NVIDIA are the master chefs who design the recipe for a new chip. But TSMC, they own the incredibly advanced, unbelievably expensive kitchen where that recipe can actually be cooked. This makes them the ultimate bottleneck. If you want to build the next great AI server or smartphone, you pretty much have to go through them.
And because they're that crucial bottleneck, business is absolutely booming. The revenue for 2025 shot up by over 31%. Now, to put that into perspective, that kind of growth is insane for a company of this size. That's the kind of number you expect from some hot new startup, not a global manufacturing type. So where's all that cash coming from? Well, this chart tells the story. A full 60% of their revenue is coming from their most advanced 3 and 5 nanometer chips. These things are the smallest, the fastest, and the most ridiculously difficult to make chips on the planet. And they're exactly what everyone wants.
And who is buying all this cutting-edge tech? The answer is right here. Over half their business, 55%, is from high-performance computing. And let's be clear, that's just a fancy way of saying AI. Every single time a company builds a new AI data center or trains a new large language model, TSMC is getting paid.
So the reward side of the equation is pretty clear, right? We're talking mind-blowing growth because they make a product everyone desperately needs. But what about the risk? What kind of massive bet does a company like TSMC have to make to get that reward? Let's break that down.
And here is the trade-off, laid out in black and white. The reward on the left is just staggering. We're talking about almost 30% growth next year and huge profit margins. But to get there, they have to swallow the risk on the right. A capital budget of up to $56 billion in 1 year. That is the price of staying on top. It's a colossal, all-in bet that they can build the next generation of factories and stay ahead of everyone else. And you don't just have to take my word for it. This quote from their own CFO explains their entire mindset perfectly. The demand for their best stuff, their leading-edge tech, is off the charts. And it's that intense demand that gives them the confidence to take on such an eye-watering financial risk. Okay, so let's hit pause on microchips for a second and see how this very same risk versus reward dynamic plays out in a completely different world: banking. We're going to compare one of the biggest names on Wall Street with a small, local player to see how they approach the game. First, the Titan, Goldman Sachs. I mean, just look at these numbers. They're almost hard to wrap your head around. But think about them through that risk lens. With over $3.6 trillion in assets, their risk is spread out over thousands of different investments all across the globe. Their whole strategy is about diversification on a massive scale. Now, let's contrast that with Bank 7. They're operating in a totally different universe, right? But check out that net interest margin of nearly 5%. That's basically the profit they make on their loans, and that is a really healthy number. It tells you that even though they're small, their business is really focused and profitable. The risk isn't spread out globally, it's concentrated right there in their local community. And this quote from Bank 7's CEO just says it all. When he talks about a properly matched balance sheet, what he's really saying is, we're not taking crazy risks. They know their local market inside and out. Their entire strategy is about being the absolute expert in one specific area, not trying to be everything to everybody. Okay, so we've looked at a tech giant betting billions on the future of AI, and we've seen two banks playing on completely different fields. So let's pull it all together.
What is the big story that all these numbers are telling us?
This right here is the single most important idea to take away from all of this. Don't just get lost memorizing the numbers. You have to use a framework, like risk versus reward, to actually see the story the numbers are telling. Every single financial report is really just a story about the choices and bets a company is making. So let's just recap it one more time. For TSMC, the game is all about that massive annual bet to stay on top of the tech world. It is the definition of high risk, but for a reward that could be absolutely historic. For Goldman Sachs, their risk is spread across a $3.6 trillion global portfolio. It's managed by being everywhere. And for Bank 7, the risk is concentrated in one region, which lets them build up that deep local expertise that bigger players just can't match. So I'll leave you with this to think about. You've got the high-stakes tech vet, the diversified global giant, and the focused local expert. Three totally different stories of risk and reward. In a world as complex and uncertain as ours, which one of those strategies do you think has the best chance of winning in the long run? All right, let's get right into it. We are talking about the absolute heavyweights of finance, the institutions that aren't just playing in the global economy, they're the ones writing the rules. Today, we're going to break down the keepers of capital. You've got the ultimate dealmaker, Goldman Sachs, the new-look wealth management powerhouse, Morgan Stanley, and of course, the undisputed king of assets, BlackRock. We're about to pull back the curtain to see how the world's money is really managed. So, here's how we're going to break it all down. First, we'll dive into the investment banking war, putting Goldman and Morgan Stanley head-to-head. Then, we'll try to get our heads around the sheer size of the $14 trillion behemoth, BlackRock. After that, it's time for the iron verdict, where we'll lay out exactly why we think Morgan Stanley comes out on top as the most solid long-term hold. Okay, first round, the classic Wall Street showdown. And look, this is way more than just about bragging rights. This is a bare-knuckle brawl for dominance over deal flow. You know, the high-octane fuel that keeps these giants running. When the markets get hot, this is where all the action is. Okay, so let's look at the big picture first. The numbers here are just massive. Goldman's Global Banking and Markets division, it raked in over $41 billion. Morgan Stanley's equivalent, Institutional Securities, brought in a cool $33 billion. But here's the really wild part. Both of them grew their revenue in these core segments by an identical 18% year over year. I mean, you can't make this stuff up. The race is just unbelievably tough. But, that top-line revenue can be a little noisy. What's really telling is when you strip away all the volatile trading stuff and just look at pure investment banking fees. This is where the rubber meets the road, right? This shows you who is actually winning the big-time client relationships that lead to those major deals. And yeah, you can see it right there. A clear leader just pops out. Goldman Sachs cleared $9.34 billion. Now, don't get me wrong, Morgan Stanley is still a beast, but in terms of pure deal volume, Goldman is the undisputed champ. So let's dig into that a little more, round by round. First up, we've got M&A, mergers and acquisitions. This is kind of the glamour division of investment banking, the most prestigious work. And honestly, Goldman is just in a totally different league here. We're talking $4.73 billion in advisory fees. Morgan Stanley's $2.89 billion is nothing to sneeze at. It's a huge number, but Goldman is the clear heavyweight champion, ranking number one pretty much across the board. But just when you think it's a blowout, Morgan Stanley comes roaring back with a serious counterpunch in equity underwriting. When a company wants to go public with an IPO, this is where Morgan Stanley really shines. They just edged out Goldman here, pulling in $1.97 billion. This is totally their turf, their stronghold. They've built an absolute machine for bringing companies to market. And for the final round, debt underwriting. And while this one was an absolute nail-biter, just look at these numbers. Goldman at $2.83 billion, and Morgan Stanley right on their heels at $2.77 billion. It's practically a dead heat. It just goes to show you how fiercely these two firms fight for every single sliver of the market. So, after all that, what's the final verdict on the deal flow war? Well, it's pretty clear. Goldman Sachs is winning. Their absolute dominance in M&A is what gives them the edge. But here's the real kicker, the thing that tells you where this is all headed. Goldman's pipeline of future deals, their backlog, is the biggest it has been in 4 years. That is a huge signal that their momentum is just going to keep on rolling. Okay, let's totally switch gears for a minute. We've been talking about the deal makers, the architects, moving all the money around. But now let's talk about the ultimate owner of that capital. So if Goldman and Morgan Stanley are the architects, you can think of BlackRock as the actual foundation that everything is built on. Seriously, this is a completely different kind of financial animal, playing a whole other game. Okay, get ready for this number. I want you to just try and let it sink in for a second.
$14.04 trillion in assets under management. That's trillion with a T. No, that is not a typo. And what's even crazier is that it's not just sitting there. That number jumped by a staggering 22% in a single year. The scale of it is just, it's mind-boggling. And you might be thinking, well, the market went up, so of course their assets went up. But that's not the whole story. Not even close. This wasn't just a rising tide lifting all boats. BlackRock actively pulled in almost $700 billion in new money from clients. That's a record. And the main engine driving all this? Their iShares ETF platform. It's just a testament to their complete and total dominance in the world of investing. But listen, it is a huge mistake to think of BlackRock as just some boring index fund company. Their CEO, Larry Fink, he has his eyes locked on the future, and he's moving fast. He's not just focused on the public stock market anymore. He's pushing the firm hard into things like private markets and infrastructure where the higher returns are, and he's even getting out in front on digital assets and tokenization. His vision? He wants BlackRock to be the one-stop shop for every type of capital, bridging the gap between old-school finance and whatever comes next. All right, so let's recap where we are. We've got Goldman, the pure deal-making machine. We've got BlackRock, the giant that wins on sheer unbelievable scale. And then we have Morgan Stanley, the transformed wealth management beast. Three totally different business models, all at the absolute top of their game. So how do you possibly pick a winner? Which one is actually the strongest? And that really brings us to the most important question for any investor, right? We've seen the numbers, we understand their game plans. So out of these three financial giants, which one gives you the best combination of stability and growth? Which one is the absolute safest place to put your money for the long haul? Well, the verdict is in, and the winner is Morgan Stanley. And the reason why is actually pretty simple, but it's incredibly powerful. They've successfully built something they call the integrated firm, and it's a business model that's proving to be just unbelievably resilient and profitable. Let's get into the numbers that back this up. And this table right here, it tells you almost the entire story. Just look at the returns first. That ROTCE number, it's basically a measure of how profitable they are. Morgan Stanley is clocking in at 21.6%. Now, Goldman's 16% is really good, but Morgan Stanley is just on another level. And then look at the client assets, 9.3 trillion for Morgan Stanley. It absolutely dwarfs Goldman's 3.6 trillion. And that isn't just a bigger number for bragging rights. That massive asset base means a much more stable, durable business. So this right here is the core of the winning argument. Morgan Stanley has fundamentally remade itself. They've basically built a financial fortress with their massive wealth management business, which gives them incredible stability. But at the same time, they've kept their world-class investment bank as a powerful weapon for when it's time to go on offense. So let's just quickly tick off the points of this winning formula. 1, you get unmatched stability from that $9.3 trillion in client assets. 2, you get superior profitability, shown by that 21.6% return. 3, you have that powerhouse wealth management engine just churning out a steady stream of fee-based income. And 4, the whole thing is built on a foundation of absolute, fortress-like capital strength. And let's talk about that wealth management engine for a second. It is an absolute beast, operating with a pre-tax margin of nearly 30%. What that means is it's a massive, predictable, fee-based cash machine that acts as a buffer. So when the more volatile deal-making side has a tough quarter, which will always happen, this division just keeps the profits rolling in. That's a defensive advantage that Goldman simply doesn't have on the same scale. And this right here might be the most crucial point of all. We're talking about their capital buffer. Morgan Stanley ended the year with an immense amount of it. They hold 3.2% more of that core capital than regulators even require. You can think of this CET1 capital as a bank's highest quality safety cushion. Having that much extra is a direct measure of their fortress-like financial strength. It gives them the flexibility to handle any storm. To put it as simply as possible, Morgan Stanley has built the perfect all-weather vehicle. They have the defensive armor of a massive, stable wealth manager, and they have the offensive weaponry of a world-class investment bank. So when times are good, they capture all the upside. But when times get tough, those fee-based businesses provide a cushion. This is the model that is built to win in the long run. So the real takeaway here is just how powerful this integrated platform has become for Morgan Stanley. And that leaves us with one final provocative question for the entire industry. As the financial world keeps shifting, can the more specialized pure-play models like Goldman Sachs and even the massive BlackRock truly keep pace over the next decade? I guess you could say, That's the multi-trillion-dollar question.
All right, let's dive into our third section. We're going to shift gears here, moving away from the numbers on a screen in the world of finance to something you can actually see and touch, the real economy. We're talking about the actual trucks on the highway, the trains on the tracks, the physical movement of stuff that really is the lifeblood of our entire economic system.
So here's the million-dollar question, right? For any investor, for any business owner, how can you see a slowdown coming before it actually hits? Well, for more than 100 years, one of the best clues hasn't come from some super complex algorithm, but from the good old-fashioned rumble of our country's highways and railways.
There's this old idea called Dow theory, and it's actually just brilliantly simple. Think about it. Before a factory stops making as many products, they order fewer raw materials. Before a retail store sells fewer TVs, well, they get fewer shipments of TVs. So the companies that move all that stuff, they're the ones who feel the slowdown first. They are, quite literally, the economy's canary in the coal mine, giving us a little heads up that something might be changing. Okay, so if we want to check the health of that canary, we're going to zero in on one of the biggest players in the entire game, J.B. Hunt. They're a giant in the logistics world, and their latest earnings report from Q4 2025, it's basically a perfect snapshot of what's happening right now with the flow of goods all across North America.
So we're going to put on our detective hats for a minute. We can't break down their entire company right now, so we're going to focus on the real heart of their operation, their intermodal business. All that means is they move goods using a mix of trucks and trains. It's the perfect economic barometer because it captures that massive long-haul movement of pretty much everything you can think of.
And here is our first piece of evidence, this number right here. This represents the sheer volume of stuff being moved. In the last quarter, J.B. Hunt's intermodal volume actually dropped by 2% compared to the same time last year. Now, you might be thinking, 2%, what's the big deal? But in an economy that's supposed to be growing, any decline is a yellow flag. It tells you, very simply, that less stuff is being shipped around.
But here's the second clue, and honestly, this one might be even more important. This isn't about how much stuff they moved, it's about the price they got for it. For every single container they shipped, they earned 2% less money than they did a year ago. That is a classic, textbook sign of weaker demand. When there are more goods than there are trucks to move them, prices go up. When it's the other way around, companies have to start cutting their prices to get business. And when you put it all together in a table like this, you really see that 1-2 punch. I mean, look at the raw numbers. Loads shipped went down from over 560,000 to about 551,000. And at the exact same time, the money they made on each of those loads fell from $2,850 to $2,808. So, they're moving fewer things, and they're getting paid less for each one. That just screams weakening demand in the real economy.
So, when you see those two things happening together, the volume of goods going down and the price to ship them also going down, it forces us to ask a really critical question. It's one that a lot of analysts are talking about right now. Has this slowdown turned into something more serious?
And based on the evidence we're seeing, the signs are really pointing towards yes. You see, a freight recession isn't some official term from the government. It's what people in the industry call the exact situation we're seeing in J.B. Hunt's numbers. A pretty significant, ongoing downturn in shipping. The engine that moves our physical economy? Well, it looks like it's losing some steam. And here's why that matters, because this is about so much more than just one company. It's about a chain reaction. It's like dominoes falling. It starts with the freight slowdown, right? That's step one. That sends a signal that, hey, consumers and businesses are buying less stuff. Step two. Well, when people buy less, companies from Target to Ford see their sales drop. Step three. And finally, step four, when sales and profits fall across the whole economy, that can eventually put a lot of pressure on the stock market.
Which brings us to the most important point. Why does this matter to you? Why should the average person with an investment account care about J.B. Hunt's shipping volumes? Well, it's because that little canary in the coal mine is singing a song about what might be coming down the pike for the rest of the market.
The story these numbers tell is really a cautionary one. A freight recession often comes before a bigger economic slowdown, and that usually means lower profits for all kinds of companies, which can, of course, push down stock prices in your 401k or your brokerage account. The sectors that really depend on you and me spending money, think retail, cars, electronics, they could get hit especially hard if people start tightening their belts. Now, we have to be fair, J.B. Hunt themselves said that some of this drop in volume was on purpose. They were making a strategic choice to make their network run a little more smoothly. Okay, fair enough. But that doesn't really explain why their prices also fell. I mean, think about it. If the market was really strong, they could have balanced their network and still charged people more. The combination of shipping less stuff and getting paid less to do it,
That points to a market that is just fundamentally weaker than it was a year ago. And so, that leaves us with this final question. Now, obviously, this isn't financial advice, but it is a really crucial piece of context. The best way to think about J.B. Hunt's earnings is like a little warning light that just started flashing on the economy's dashboard. It doesn't mean the car is about to break down, not at all, but it does suggest that paying a little closer attention to the road ahead and maybe, just maybe, easing your foot off the gas a bit might be a smart way to navigate the rest of the year.
You know, after the year we've all been through, it feels like every time banking comes up in conversation, there's this cloud of uncertainty hanging over it, right? We've seen collapses, crazy rescues, and just a whole lot of fear. But what's really happening behind the headlines? Today, we're going to cut through all that noise. We're going to look at the hard data, from a regional giant all the way down to a tiny hidden gem that might just blow you away. All right, so here's the game plan. We're going to start with the two big questions that I think are on every investor's mind right now. Then we'll put a major regional bank, First Horizon, under the microscope and see how it holds up. After that, we're going to zoom way in on this fascinating little bank called Bank 7 and really break down the bull case and the bear case. And we'll wrap it all up with the big dilemma this all creates for investors. With all the chaos in the banking world lately, it is so easy to get lost in the weeds. But honestly, when you really get down to it, for most of these regional banks, their survival and success really just boil down to two critical make-or-break questions. And here they are. First, is money walking out the door? Are people getting scared and pulling their cash? And second, just how exposed is the bank to that commercial real estate ticking time bomb that we keep hearing about? So we're going to use this simple framework to get some real data-driven answers, and we're starting with a big one, First Horizon. Okay, first up, let's put First Horizon under the microscope. Now, this is an $84 billion bank we're talking about, a real powerhouse across the southern U.S. They're a great test case, kind of like a bellwether for the health of the entire regional banking sector. So let's hit them with that first question. Are their deposits stable, or are customers running for the hills? So what you're seeing here is a peek inside the vault, so to speak. This is First Horizon's massive $67.5 billion deposit base. Now, there are a lot of numbers here, but the one that tells the real story, the one that clues us into their health, is the one that tracks their cheapest source of funds. And boom, right away we see this, negative $200 million. Now, at first glance, that looks kind of scary, right? The bank lost $200 million of its absolute best kind of money, that free cash that people just leave sitting in their checking accounts. That's the capital that banks absolutely love because they don't have to pay a dime of interest on it. So yeah, seeing that number go down could definitely make you a little nervous. And just so we're all on the same page, you can think of these non-interest-bearing deposits as a bank's free inventory. It's the stuff they can lend out to make a profit without it costing them anything. So when you see that inventory start to shrink, it can be a red flag that their cost of doing business is about to go up. But is that the whole story for First Horizon? Well, here's where we get the bigger picture. And the answer is a resounding no. Because while they lost a little bit of that cheap money, look at this. They attracted a massive $2 billion in new deposits overall in the same period. This tells you customer confidence is strong. People aren't leaving, they're actually bringing more money in. They swapped some cheap money for slightly more expensive money, but the crucial takeaway is that they grew. The ship is steady. Okay, so question number one, are deposits fleeing? Looks like a solid no, they're stable. So now we've got to move to the second big fear that's been haunting the markets, that so-called ticking time bomb of commercial real estate, or CRE. And whoa, okay, that is a big, intimidating number, $13.6 billion. That's how much First Horizon has loaned out against commercial real estate. And you look at that and you think, man, if that portfolio goes south, the whole bank is in a world of hurt. But as always, that big, scary headline number, it almost never tells the whole story. The devil's in the details. And when you actually break it down, the picture gets a whole lot clearer. You see that the category everyone is terrified of, traditional office space, with all the empty buildings and falling values, it's actually the smallest slice of their CRE pie, just $1.3 billion. The bulk of it is in other areas, and a huge chunk is in multifamily housing. But even that little slice of office risk isn't quite what it seems. Because this right here, this is the key. This is their secret weapon. More than half of that supposedly risky office portfolio, it isn't in corporate skyscrapers. It's in medical facilities. Think doctors' offices, clinics, labs. These are tenants that are far more stable and resilient than your average tech company. This isn't just luck. This is smart, deliberate risk management at work.
So our big regional bank, First Horizon, looks remarkably solid. But what if we look at the complete opposite end of the spectrum? What if the real opportunity is hiding out in a place nobody's even thinking to look? Let's zoom our microscope way, way in on a tiny, under-the-radar bank called Bank 7.
And I'm not kidding when I say tiny. Just look at the size difference here. First Horizon is an $84 billion giant. Bank 7 has $2 billion in assets. I mean, First Horizon is over 40 times bigger. But as we're about to see, when it comes to performance and sheer profitability, this little bank punches way, way above its weight class. And you can just feel the confidence coming from their CEO here. This is not some sprawling, faceless national bank. This is a super focused operation, just 12 locations, and they serve entrepreneurs in Oklahoma, Texas, and Kansas. They really believe they have a winning formula, and they're not afraid to say it. So let's see if the numbers can back up that swagger. Okay, this is where things get really interesting. Because with a small bank like this, everything is amplified. The potential rewards are huge, but the risks are just as big. So we're going to lay out both sides of the argument. We've got the bull case, all the reasons this stock could be an absolute home run, and then we have the bear case, outlining the very serious things that could go wrong. Let's start with the bull case, and it kicks off with an absolute showstopper of a number. We calculated their return on assets, that's net income divided by total assets, and we got this phenomenal figure, over 2%. Now, to put that into perspective, a really good, solid bank might have a return on assets of 1%. Anything over 1.5% is considered excellent, but over 2%, that is truly elite territory. And it doesn't stop there. Here's another incredible figure for the bulls. Their net interest margin, or NIM, that's the core measure of a bank's profitability, is nearly 5%. That is almost 1.5 full percentage points higher than that giant we just looked at, First Horizon. They are just masters at squeezing more profit out of every single dollar they touch. And they're not just insanely profitable, they are growing at a blistering pace. In a year full of economic uncertainty, they managed to expand their loan book by nearly 15%. So that's the bull case in a nutshell. You've got elite profitability, incredible margins, and super fast growth. It's a powerful story. Now, let's look at the other side of that coin. And here's the essential conflict, the real dilemma for any investor looking at Bank 7. The very things that make it so compelling, that laser focus, that aggressive growth, are the exact same things that create all the risk. It's truly two sides of the same very high-stakes coin. So let's break down those risks. So what could go wrong here? Well, first off, while their assets grew, their actual take-home profit, their net income, actually fell last year by almost 6%. That's a huge warning sign. Then there's the concentration risk. They have all their eggs in one basket, just 12 locations across Oklahoma, Texas, and Kansas. That makes them incredibly vulnerable. Their entire business is tied to the health of the energy and agriculture sectors. If there's a regional downturn, their core customers get hit hard, and Bank 7 has absolutely nowhere else to turn. So where does all this leave us? Well, we've looked at two completely different banks on opposite ends of the spectrum. You've got First Horizon, the resilient giant, the big steady ship that's proving it can manage risks and maintain stability. And then you have Bank 7, this small, incredibly profitable speedboat that could either fly to the moon or completely capsize depending on the economic weather. And that leaves us with one final provocative thought. The data seems to suggest that the widespread fear around these big, well-run regional banks might be a bit overstated. But at the same time, the incredible potential you see in smaller, overlooked players like Bank 7 is tied directly to some significant concentrated risks. So the question for any investor isn't just about finding growth. It's about really understanding what kind of risk you're willing to take to get it, and where on that spectrum does the real opportunity lie. All right, for our final company, we're going to shift gears completely. We're moving away from high finance and those tiny silicon chips to something you can actually, touch and feel, Insteel. Now, it's really easy to just call them a materials company and move on, but that's not the whole story. You should really see Insteel as a direct play on one of the biggest themes of the next decade, the massive, and I mean massive, rebuilding of our national infrastructure. So what does Insteel actually do? Well, every single time you drive your car over a bridge, or walk into a skyscraper, or even just pass one of those giant new data centers popping up everywhere, you're looking at their work. You just can't see it. InSteel is the largest U.S. manufacturer of the steel wire products that reinforce concrete. It's the steel skeleton that gives concrete the essential strength and durability our modern world is quite literally built on. Okay, so that's the big picture story, right? It sounds great, but does it actually translate to the bottom line? Does being the picks and shovels supplier for this infrastructure boom actually build a strong business? Well, the numbers are going to tell us if this theme is creating real, tangible value. So let's take a look. And yup, here is the proof, a 23.3% year-over-year increase in net sales. This isn't some fuzzy projection about government contracts that might happen in the future. No, this is impressive growth that's happening right now. It just confirms that the demand for these foundational building materials is incredibly strong, and InSteel is sitting right in the sweet spot to meet it. And you don't even have to guess where this growth is coming from. The company's CEO, H.O. Waltz III, says it himself. He directly links their amazing performance to infrastructure spending and, this is also huge, data center construction. That's another massive growth trend. So this shows InSteel is right at the crossroads of several powerful economic forces, getting a boost from multiple angles. So we have covered a ton of ground today. We've looked at a global banking giant, a semiconductor titan, a regional financial powerhouse, and now an infrastructure linchpin. Each one has a really impressive story for sure. But with all the pieces now on the board, it's time to put our main contenders head to head. This is it. This is the question we've been building towards this whole time. After digging through all of these reports, analyzing these totally different sectors, who really, truly delivered the most explosive earnings growth this quarter? Okay, enough talk. Let's get straight to the data. Okay, here it is, the breakdown. Morgan Stanley, a Wall Street stalwart, posted a very solid 20.7% year-over-year growth in earnings per share. That's excellent. Then you've got TSMC, the undisputed king of semiconductors, hitting a fantastic 35% growth, no doubt fueled by the AI revolution. But then you look down just one more line, First Horizon, that regional bank delivered a jaw-dropping, absolutely stunning 79.3% year-over-year EPS growth. Based on that incredible performance, which, let's be honest, stands head and shoulders above the rest, one clear winner has emerged from this quarter's earnings season. So, the crucial point is, who had that undeniable momentum? The data? Well, the data makes the choice for our top pick this earnings cycle unmistakable. It's First Horizon Corporation. Yeah. Despite competing for our attention against some of the world's largest and most followed companies, this regional bank just went and delivered a financial performance that was, simply put, outstanding. And this number right here is exactly why, a nearly 80% surge in year-over-year earnings per share. Look, in a quarter where 20 or even 30% growth is considered a huge victory, First Horizon nearly quadrupled that. It just showcases the sheer power of their disciplined execution and their really strong market position. So after that deep dive into all the numbers, what's the key lesson here? What's the one thing you should really take away from all this? For me, it boils down to one simple yet really powerful idea. It's this: powerful growth often comes from the most unexpected places. It's so easy to just focus on the biggest names in tech, the titans of Wall Street. But as we saw so clearly today, sometimes the most explosive performance comes from a well-run regional bank that is just quietly and effectively crushing its strategy. It is such a vital reminder to always, always look beyond the headlines. And that is our explainer for this week. If you want to keep digging beyond those headlines to find the real stories the numbers are telling, well, you know what to do. Make sure you subscribe to IIIN Financial. We will be back next week with a whole lot more.
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.